And thank you, Frank, for inviting Afrinvest to be part of this policy roundtable by Business Day on the subject of banking recapitalization. My name is Ike Chioke. I'm the Group Managing Director of Afrinvest, and it's my humble privilege to take you through this presentation on the banking recapitalization. My presentation will be in 5 sections. We'll do sort of a recap of what the CBN's announcement means and implications for different banks. We'll look at the gap for various banks as a result of that announcement. We're going to spend some time in section 3 to talk about the experience of the 2004-2005 banking recapitalization. And I must say that was about the time that Afrinvest became fully established in Nigeria, and that wave of transactions propelled the prominence of our company. Section 4, we look at the potential approaches banks could take to recapitalize. And then lastly, we look at the implications coming out of all of this. The CBN came out about 2 months ago to announce that they're recapitalizing the banking industry for several reasons. Macroeconomic challenges that is necessary to increase the bank's minimum capital so that to strengthen banks against external and domestic shocks, as well as macroeconomic headwinds. Stabilize the banking system by increasing the banking minimum capital, aims to have banks have a more robust capital base to absorb unexpected losses, as well as enhance their capital buffers. And then for economic growth, it will lead to the emergence of stronger, healthier, and more resilient banks, supporting the president's goal. President Bola Ahmed Tinubu has announced his intention for Nigeria to get a $1 trillion economy by the year 2020. And clearly banks can and should be a catalyst to that. From the announcement, today we have these various license types: international, national, regional, merchant bank is national, non-interest bank, national, regional, commercial has these 3 categories. But remember in 2005, when Soludo did this recapitalization, there was basically universal banking. We didn't have this categorization. So basically it said minimum capital around then was 2 billion naira. All banks moved to 25 billion. In 2010, following the repeal of the universal banking system, we then had the categorizations emerge. So international commercial banks had 50 billion, national commercial banks were at 25, and regional commercial banks were 10. And then merchant banks were introduced. They could have 15. Non-interest banks, 10 billion for national, and non-interest banks, 5 billion for regional. Now, with the new announcement that came out a couple of months ago, international commercial banks have to go from 50 to 500, implying a 900% change. National commercial banks are going from 25 to 200, a 700% increase. And then regional commercial banks are going from 10 to 50, a 400% increase. Furthermore, if you look at merchant banks, they are going from 15 billion to 50 billion, a 233% increase, while non-interest banking are going from 10 billion to 20 billion, just a 100% increase for national, and for regional, 5 billion to 10 billion, another 100% increase. So on paper, you can see that all looks very good in terms of the percentage increase of capital, leading to stronger and bigger banks that will continue to propel the economy. But if you look at it in real terms, and what we did here was to look at the effect of inflation. From 2010, particularly when we had the repeal of universal banking to 2024, so from an inflationary change, is actually only 135% increase for commercial banks that have international license, only 88% increase for national banks with international license, and only a 17% increase for national banks with regional license. And all the other ones actually point to a negative position if you just adjust the increases by inflation. If you then just look at it based on foreign exchange rate, you can even see that the effect is also quite similar. The increase for national banks, international commercial banks, is only 130% based on the exchange rate in 2010 compared to 2024. If you go further back to 25 billion, it's even more glaring. And then for national commercial banks, exchange rate adjusted is only an 84% improvement. Regional is only a 15% improvement. If you then go to the other ones, it's actually a negative number. So we're giving with one hand and we're taking back with the other. So the policy itself, when you look at it, needed to be further sort of probably fine-tuned. When you look at Nigerian banks, and we just looked at a selection of some of the top 10 banks in Nigeria in terms of total assets, total deposits, and total loans. And you see, again, these are based on their 223 audited accounts where we have found them, and some have 2023 management accounts unaudited. But when you compare the totality of the top Nigerian banks, only $180 billion of total assets. And then look at Brazil. Today, their banking industry, top 10 banks, $1.6 trillion of assets. Indonesia, $523 billion of assets. Mexico, $266 billion. Clearly, we have quite a long way to go. And the reason I chose these countries was because they are closer to the $1 trillion mark in terms of the size of the economy. And just to show you the size of the top 10 banks. So there's still a lot of work for Nigeria to do. Mexico looks within reach relative to banking assets, but there are also some variables that we still have to work on. And this slide, let me pause there, is interesting. What the bubble represents is the bank assets to GDP for each country, yeah? Today, we look at the total of Nigeria, all the bank assets in Nigeria. Nigeria has a GDP of $0.5 trillion. Bank assets to GDP is only 16.4%. We also profiled countries that are close to Nigeria in terms of GDP size, like Egypt, South Africa, Kenya. And you can see bank assets to GDP in Egypt, 100%, South Africa, 74%, Kenya, 47%, significantly higher. If you come to the $1 trillion mark, Netherlands right there, bank assets to GDP are 104, but let's jump that because it's a developed country. Similar countries might be Indonesia, $1.3 trillion, 43% bank assets to GDP. Mexico, $1.5 trillion, 45% bank assets to GDP. If you want to look at Brazil, further away, $1.9 trillion, 125% bank assets to GDP. So there's clearly something structurally different with the Nigerian economy, that the bank access to GDP is actually very low when you compare across similar comparable countries. And you can even see Australia, 148%, Korea, 181%, Spain, 119, Netherlands, 104. So typically, even Turkey here at 0.9 trillion is 89%. So clearly, there's a lot of work for Nigerian banks to do to get to the promised land. So on this section, section 2, I'll be dwelling on the gap implied by the recapitalization announcement. This is a summary page, and we looked at all the commercial banks in Nigeria today and all the merchant banks and all the non-interest banks. We see that based on the CBN capital requirement, there's a need for the Nigerian commercial banks to get to 5.7 trillion naira. But today they're about 1.9 trillion naira. So 5.7 trillion at current exchange rate, which is moving every day, sort of. It's $4.4 billion. They are currently at $1.5 billion, which is 1.9 trillion naira. And so the gap is 3.7 trillion naira for the entire commercial banking industry. And this is assuming that retained earnings is not included because that came with the announcement. If you look at the merchant banks, there are 300 billion naira altogether. That's the gap, the capital requirement for all of them. They're currently at 99 billion. So the 200 billion naira gap for merchant banks to get to where they should be. The non-interest banks have a much easier job. They need to be at 40 billion and they are currently at 35 billion. So it's chicken and change for them. It would be no-brainer. But if you add all of this together, we're looking at industry gap of 3.9 trillion for the banking industry to meet the CBN recapitalization requirements. And this will not be an insignificant job. 3.9 trillion will mean that they'll go today from an industry that has a capital of $1.6 billion, 2.1 trillion naira, to one that will be at $4.6 billion, 5.9 trillion naira. If you then go to succeeding slides, sorry. I'm having some technical issues. Your slides are not moving. Aha. I just wanted to show, like, we then want by category tier 1 banks, Access Corporation, First Bank Holdings, UBA, GTCO, Zenith, and work out share capital, share premium, qualified capital, CBN requirement, and the gap. And it seems all of them are doing something like about 250 billion of extra capital, with maybe GTCO the highest to raise about 360 billion naira capital based on the announcement. Yeah. If you go to the tier 2 banks, EcoBank, Fidelity, Stanbic. Fidelity chairman is here. We will be seeing, oh, sorry, that was a mistake. I would correct it in the next presentation. But you see share capital, share premium, qualifying capital based on CBN analysis, CBN requirement, and the gap that is here. And we see quite some numbers that are quite high, but the totality is that all of them need to raise about 2.3 trillion naira together, where tier 1 banks need to raise about 1.4 trillion naira. The merchant banks, RAN, Nova, FBN Quest, Coronation, FSDH, and Greenwich Merchant Bank, 200 billion naira to raise to meet the gap. And the Jaiz, Lotus, and Taj among the non-interest banks only need to raise a much lower number. Now, what happens is that when we then assume that perhaps there'll be discussions, like my chairman said, and the explanation as to why do we need to do certain things. And maybe if you allow for 50% of retained earnings to be accepted, because they're still, not all retained earnings is real estate, there's liquidity in there, then you could see that most of the tier 1 banks will be well capitalized. Say for GT, that would be looking for something like 71 billion. And if you did the same for the tier 2 banks, a few of them will be well capitalized, Stanbic certainly, but others will still need to find money, about 1.9 trillion in total. The merchant banks are relatively new. They'll still be looking for the same number, while the non-interest banks is really 1.4 billion naira required to close the gap. So that sort of gives you some perspective as to what the implications of this announcement means. But if you start out with 3.9 trillion naira to look for in this market, I dare say it is not a small problem. And of course, the implications of banks when they have a lot of capital and not enough access to deploy them onto can be daunting, as Mustafa can tell you from his experience at AMCON. So now we take a moment to review what happened in 2004 recapitalization. You may recall that it was about June of 2004, Governor Chukwuma Soludo Dr. Chukwuma Soludo was the governor of the central bank and announced the banking recapitalization. that all banks should move from an average of 2 billion naira capital to at least 25 billion. And he gave everybody 18 months, starting from July of 2004 to December 31st, 2005. The effect was this. At the time of the announcement, we had 89 banks operating in the system with 311 billion naira of capital. At the time, about $2.4 billion, I think. Minimum capital of 2 billion. We ended up by December 31, 2005, with 25 commercial banks, each with a minimum of 25 billion. But interesting things, only 6 banks achieved that mandate through increased capitalization. They went out to raise money. And 19 banks were emerged through mergers and acquisitions in that period. And they've had different consequences. These are the 6 banks that were independent. So Zenith, GTCO, EcoBank, Standard Chartered, Stanbic Bank, and Citi, which was then called Nigerian International Bank. They all raised enough money and moved their shortfall to get to the 25 billion. They didn't acquire anybody. But then we had the emergence, but on the 19 banks, remember Sky Bank is now operating at Polaris Bank. There was a merger of Prudent, Bond, Reliance, Cooperative, ETB, and Capital, to form the new Sky Bank. They are still operating at Sky. Remember Spring Bank, Citizens, ACB, Guardian, Omega, Trans International, Fountain Trust, Capital, to get to that Spring Bank. Spring Bank subsequently became Enterprise Bank, which was then subsequently acquired by Heritage Bank. And I have to say that some of those challenges are still haunting Heritage Bank today. Okay, there's Sterling Bank, which was a merger of Trust Bank, NBM Bank, Magnum Trust, now an Indo-Nigeria Bank. Yeah, there's UBA. UBA was a reverse merger, actually, because you had Continental Trust, which was part of Standard Trust Bank, combining to then merge with the UBA, and then the smaller guy acquired the bigger guy, and that's the new UBA you have here. It's still running, bigger and better. Union Bank, you had Union Bank, Union Merchant Bank, Broad Bank, Universal Trust Bank, made it into capitalization. Current issues with Union Bank and their Titan Trust deal with the new CBN. Unity Bank, again, a sort of a large friends and family arrangement, Intercity, First Interstate, Tropical Commercial, Center Point, Bank of the North, New Africa, Societe Bancaire, Pacific Bank, and New Nigerian Bank. Some of the challenges of that deal are still haunting Unity. Continuing, you have Access Bank. It was Access, Marina International, and Capital Bank. Bank PHB was Platinum Bank and Habib Bank. That is now operating as Keystone Bank. Equatorial Trust Bank, then was with Devcom Bank. That has now been taken over by Sterling Bank. Afrinvest merged with this merchant bank. And I think it became Main Street Bank. And it's gone into somebody. Polaris, yes, Polaris acquired it, which is now, it was acquired by Sky, which became Polaris. Diamond Bank emerged successfully from that period, but it's now gone into Access Bank, is no longer there. Fidelity Bank is still waxing strong. Fidelity, FSB International, and Money Bank. First Bank with MBC International, FSB Merchant Bank still running. IBTC Chartered Bank, remember? IBTC with Chartered Bank and Region Bank, but IBTC has disappeared. This logo is wrong. This is not the old IBTC logo. IBTC has now disappeared into Stanbic Bank. That happened post the consolidation. So this should be actually a cross, a red mark here. FCMB, First City Monument, Co-op Development Bank, Nigeria American Bank, and Midas Bank merged. Wema Bank was Wema and National Bank of Nigeria. Intercontinental was International Bank. That was International Bank, Global Bank, Equity Bank, and Gateway. Intercontinental has now gone into Access Bank. Oceanic Bank is no longer running with Oceanic Bank and International Trust Bank. They've disappeared into EcoBank Nigeria and FinBank, First Atlantic Bank, Inland Bank of Nigeria, IMB Bank, and NUB subsequently been acquired by FCMB. So you can see that of the 19, I think only 11 are still in operations. And sometimes it just means that some of these mergers or forced marriages, if I may borrow MCO's analogy, you know, using your son as an example, yeah, go and get married and settle down, but don't, don't go to a sleazy place anyway. So moving on. So you can see then that the total capital base of the banking industry pre-consolidation was $2.4 billion. The capital they raised was about 311 billion naira, again, 2.4 billion. The total amount of capital raised, 445 billion, $3.4 billion. So the total of capital base plus capital raising came to 755. But at the end, when the CBN reported, and then this data is coming from CBN actually, we had 932 billion of capital for the industry in December 2005 at $7.8 billion. You recall that based on the current CBN's guidelines, I showed you a slide earlier that if we get to that 5.9 trillion, we'll still be at about $4.4 billion. So in dollar terms, we'll still be smaller than the banking industry was in 2005 at the end of consolidation. So, and on top of that, there was a valuation premium. And I'll explain later how valuation premium arises because, you know, not all shares you see in the market should be bought. I have the MD of NGX here, so he can explain some of those niceties. But there were some hangovers from the banking sector recapitalization. After the 2004 banking sector, we had a lot of excess capital in the system. Many banks then created all sorts of subsidiaries, you know, issuing house, asset management, securities, trust services, register, real estate business, all sorts of things. Of course, risk management became a big issue. And in no time, there was just masses of non-performing loans. And this was coming as the global market was experiencing an unprecedented boom, especially the US, supported by credit default swaps and all the real estate that was being created in Mustafa's former offices in America. And subsequently, we had the losses. And in 2010, AMCON was established, and the new CBN governor, Lamido Sanusi, repealed the universal banking model and said banks, you know, you have to either remain as pure play commercial banks or you become bank holding companies. And that was the end of that model. AMCON was created. The book value of acquired non-performing loans, we recall, was around 4 trillion naira, of which they paid about 1.8 trillion for to start up. But I'm sure Mustafa has all those details. But that shows you the negative consequences of capital raise. I saw a video going around when you just raise capital and you don't really pursue development, you know, lending to the real sector, what you just create is just asset bubbles all over the place. And at some point, the bubbles will burst. So here we want to dwell on how banks might want to approach recapitalization. Typically, where we are today, rights issues, the starting point of intervention is to look at your existing shareholders and see, do a rights and see if some of them have the capacity to put money into the bank. There's also private placement where you're selling shares to private investors if you're a private bank. But in some cases, public companies can also do a private placement, you know, and sell no more than 30% of their issued capital to one single or a group of investors. And if you're not public, you can come and do an initial public offer where you list the shares, allowing you to access a wider base of investors. If you're already public, you can do an offer for subscription and come out and sell additional shares and raise the money directly from the markets. And if all of these still don't work, you can consider mergers and acquisitions. I dare say that the track record of forced marriages has not been very positive in Nigeria. And last but not the least, if you can't raise the money, then you may want to consider a license upgrade or downgrade, as the case may be. So if you were once a national bank and you can't make it to national, you may then downgrade to regional, and you don't have the need to raise the money. We show here just the public market valuation of selected banks. And I'd like you to focus on price to book value, this column, which is a proxy. This is the basic, easiest way to value banks. You can see the different multiples at which they are trading. Access Corp at 0.26. This is based on yesterday's closing. FBN at 0.51, GTCO 0.66, UBA 0.42, Zenith at 0.43. If you come down here, ETI 0.37, FCMB 0.3, Fidelity, a nice premium at 0.66, and Stanbic 1.28, Sterling 0.67, and Wema 0.58. But you can see that industry average here is 0.5, average here is 0.6. Obviously, if people are valuing a bank based on the capital, if it's below 1, then it's almost like it's clear that the bank is undervalued unless you suspect that that capital is not there. But I think there are bigger macro issues in Nigeria why Nigerian banks are not trading at around 1 to say 1.5 times, which is why they should be. If you compare the trading of Nigerian banks, again, looking at price to book value multiples, you can see that in Brazil, the average is 1.6 times, which should be about right. You know, a little premium for the capital you've established as a going concern. Indonesia, 1.5. In Mexico, 1.9 times. China, surprisingly, 0.4. But UAE at 5. Malaysia at 4.6. And Qatar at 4.8. I don't know what those banks are eating, but that's impressive. Saudi Arabia at 7. India is closer to ground at 2.1. So clearly, Nigerian banks are clearly undervalued relative to their peers. But I think that the better benchmarks would be sort of Brazil, Indonesia, and Mexico. Again, these are the countries that are nearest to us, who are emerging markets in our journey to becoming a $1 trillion economy. So the reason I wanted to point you to that is that when you then come to buying bank shares, you know, it's not just, oh, this share price is 5 naira and the other one is 10 naira. So it's the 5 naira is cheaper. Let me go and buy a 5 naira stock. No, I've had such interesting sessions. It's actually trying to work out what the valuation can be. And I'll give you a scenario of a bank A at inception, say using the 2004 recapitalization as a template. At inception, it was a bank with 2 billion shares, private bank at 1 naira par value. It was put up by two guys, you know, let's say Frank and MCO here, put up capital, running their bank nicely, no problem, until Soludo says you need to raise capital to 25 billion. So the two shareholders have 100% of the bank. What did they do? Because they never really looked at valuation, they will just say this 2 billion is what you put, 2 billion is value of the bank. To now get to the journey, they say, okay, let's do first a small private placement. They then come out and sell 1 billion shares, 1 billion units at 1 naira par value, each share at 2 naira 50 kobo. What have they done? They have now valued their shares, because when you sell those shares, it means all the other shares are also the same value. 2 naira 50 kobo per share. Original shareholders are still holding 2 billion units of shares. The new shareholders have 1 billion units. So it's now 66% to 33% ownership. New capital raise 2.5 billion. But the implied valuation of the bank, nothing has changed in this bank though. Has suddenly gone from 2 billion naira to 7.5 billion naira. And see, so the implied book value, this one is 1 times. This now, the whole book value, including the 2.5 plus the original 2 billion, will be 7.5 divided by 4.5. You get 1.7 times, assuming all that money comes in. Now, this is now it gets more interesting. Having done a private placement, they would then approach the stock market and say, we want to do a listing by introduction. But the exchange will tell them, sorry, we only list shares when they are 50 kobo par value. So you have to go and do a stock split. Then they take their 3 billion shares and do a stock split and now have 6 billion shares. But the ownership is still the same proportion. Original shareholders have 4 billion. The new private placement investors have 2 billion. But they've now decided to list the shares at 2 naira 50 kobo on the stock exchange rather than at 1 naira 25 because it should be half, right? But I'm just trying to give you some of the excesses that happened back in 2004. So you then see, okay, private placement was 2 naira 50 kobo, listing by introduction is 2 naira 50 kobo. It looks like the same. No, actually they've just doubled the valuation of the company. Yet again, it's gone now from 7.5 to 15 billion. There has been no change in the balance sheet or income or prospects of this bank. You watching? Again, the price to book value has simply then gone from 1 time to 3.3 times at this point. Now, and this is the main thing. Subsequently, and then, so the time frame that we saw on average was maybe 2 to 3 months from itself, from standalone to private placement, and that 2 to 3 months listing by introduction. And then lastly, they come to then to do the initial public offer, at which point they then say we are selling, when you put shares on the market, you can see some stocks that have been listed by introduction. There are no shares available for sale, but you can see the shares going up. Sort of a magic I say can't understand, but the share price is going up, but the shares are not available for you to buy. So the shares could trend up to around 6 naira in the market. Eventually, they then come and say, we're going to do an initial public offer, but we're going to sell these shares at a discount to market because the market is at 6 naira, but we're selling at 5 naira. Oh, by the way, we are selling 6 billion shares. At that point, we're trying to raise 30 billion. By the time they're done, the new investors will own 50% and have brought in 30 billion naira. The old investors that brought in 2 billion naira still with 33% of the company. So if you look at this price to book value on a pre-money basis, it is very high. It's approaching the 5 or 6 times that you see. Assuming all the money comes, of course, it adjusts to 1.7 times. But the bottom line is that this kind of approach cannot happen today. And I believe what has happened, the lessons we've learned from the excesses of 2004 is that at each stage, if you have done this private placement and you now wanted to come and list it, you will have had to show us audited financials to confirm that the company has grown. Again, if you now have done the listing and you want to change the price, we'll have to then see again another set of audits. So the delay, the way the regulatory environment has improved as a result of the challenges we saw from the excess troubles of 2004 has helped the system. But of course, investors have also learned, and the Chinese have a proverb, fool me once, shame on you. Fool me a second time, shame on me. And this time around, we will not be fooled. We will shine our eyes as we come in to look at these banking stocks. So this is the last section of my presentation where we talk about the implications. Given what CBN has announced that retained earnings will not be included, from an accounting point of view, if you have retained earnings of, say, 1 trillion naira and it's not going to be counted as your qualifying capital, the smartest thing to do is to distribute it. You're not allowed to distribute it. So we're stuck. Okay, so that is out. So there's no way to get into that structure. Otherwise, then the next thing is to start looking at rights issue. Because if you can't distribute the dividend, then it means that new investors are going to come in and buy this company at a deep discount to what is actually worth, given what you have. And that's really painful for the existing shareholders. But altogether, our view is that as we are working on this journey for recapitalization, one area to focus is increased risk management, even at the central bank itself, because their capacity to supervise is also going to be challenged when these banks get all this additional capital. There is a potential for capital importation if banks have to go and seek for capital outside. But I dare say that from the experience of the previous recapitalization, what we saw that was between 2004 and 2005, most of the capital raise came from Nigerians. It was in 2006 and 2007 that the foreigners came in to join us in the IPOs that subsequently happened, but they also were quick to sell and run before the market crashed in 2008. Ultimately, the focus should be that the federal government and most of the states should be preparing real sector projects that can be financed and that are bankable. Because if money goes into the real sector, it creates more growth and more opportunity and actually propels the economy. If the money comes into Lagos, in say Ikoyi and VI and it's funding real estate, it creates massive asset bubbles. And you then have little enclave economies that are way overpriced and ultimately will crash and destroy the economy. But we hope that all things work well. Yes, please. Mm-hmm. That's true. And unfortunately, we're in one of these catch-22 position because the federal government is the biggest borrower. Yeah, and by printing money and borrowing it, they are sending cash into the system. If we get to a point where the government can have a balanced budget, then the CBN will have the capacity to actually lower that. And the banks can come into the real sector. So it needs a lot of discipline at the fiscal side as well for this side to work. So on that note, ladies and gentlemen, I thank you.
Thank you very much, Dr. Ike Chioke, for that insightful and detailed presentation. It was more than just a keynote. It was a presentation. So thank you very much. Once again, please give him a resounding round of applause.